Hi, I'm Jeff Lovell, a staff accountant with AA Accounting, and today we're discussing whether S corporations are right for your business. S corporations cannot have more than 100 shareholders, who must be U.S. citizens or residents, individuals, estates, or trusts. Partnerships and other corporations cannot be S Corp shareholders. S corporations can only have one class of common stock. Preferred stock is not allowed, and they're subject to several special taxes. To become an S corporation, all shareholders of an already incorporated business must consent to be taxed as an S corporation. They then complete and file IRS Form 2553 within 2.5 months. For example, if the shareholders want the corporation to be taxed as an S corp for calendar year 2016, the form must be filed with the IRS by March 15th of 2016. If the form is filed after this date, the election will not take place until calendar year 2017. Shareholders should consider whether being taxed as an S corporation makes sense for their specific situation. Generally, shareholders who are in high personal income tax brackets and whose companies will not have many losses will benefit from C corporation status, although any distributions will be taxable to them. By contrast, shareholders who are in a low income tax bracket or whose corporations will have large losses to distribute to them will benefit from electing the S Corp status. S Corp distributions are only taxable to shareholders if they exceed the shareholders' basis or their investment in the company. For example, if a shareholder is in the 28% tax bracket because they have wages from another job, and their corporation has earnings of $30,000, electing the C Corp status would save the taxpayer over $5,000. By contrast, a shareholder with no other income and corporate earnings of $80,000 would save over $2,000 by electing the S Corp status. Converting an existing corporation to an S Corp has some disadvantages. For example, the corporation cannot carry over any operating or capital losses it incurred while it was a C Corp. Therefore, shareholders should consider carefully whether it might be better to use up these losses first before making the conversion. Also, any assets of the C corporation that are transferred to the S Corp will be subject to a built-in gains or big tax of 35% if they're sold at a gain within 10 years from the conversion date. Assets purchased by the S Corp are not subject to this tax. S corporations are also subject to an excess net passive income or ENPI tax. If more than 25% of their income comes from a passive source, such as interest, dividends, capital gains, real estate investments, and the corporation has prior accumulated earnings, the tax is equal to 35% on the excess passive income. Also, the IRS recently has been cracking down on S corporation shareholders who actively work for their business but fail to pay themselves a wage as required by law. Therefore, S corporations with one shareholder may wish to consider an LLC as an option to avoid payroll complexities. If you have questions or need help, give the tax experts at AA Accounting a call. We have over 60 years of tax and accounting experience and want to see your business grow. We're available year-round to assist you and look forward to hearing from you.